Hello and welcome. This is KYC. Well, in this show, we talk to you about a single company every day and take you through how the company has come through in terms of its performance over the last few years, what it's been doing, as well as what we can expect from the company going forward, and give you a all-round view on the company and its operations. Well, today we are talking about EPack Durable. Now, this is an electronic manufacturing services company, and it was actually incorporated back in 2003. So it's been around for a little over a decade, 2 decades, pardon me. And it started off as a contract manufacturer for, well, room air conditioners specifically. At the moment, it has 3 manufacturing facilities with clients including Voltas, Haier, Philips, Godrej, Daikin, as well as Havells. And it has, in fact, now diversified into small appliances since 2013 as well. Well, to give you a very quick and brief tour about how it has, in fact, ventured forth when it comes to the various segments, back in the calendar year of 2002, it started off its contract manufacturing, and it moved on and entered into manufacturing induction cooktops back in the calendar year 2013. In 2017, what it did was commence operations when it comes to water dispensers, and moving on, coming down to 2018, it also introduced mixer grinders to SDA product portfolio, and finally, as far as 2023 is concerned, that's just a couple of years ago, it also commenced Sri City plant with expanding to the SDA capacity. Well, overall, in terms of size, it's a relatively smaller EMS player, but do remember that a lot of these EMS players have gained in size and momentum in a very short span in time. So I reckon that EPack also stands to potentially gain from that momentum of the sector it is already a part of. Now, what we usually do when we consider all such companies as we rate them on parameters, on various parameters. So we give it a thumbs up, a thumbs down, or a neutral rating on, well, parameters like income statement, balance sheet, cash flows, as well as return ratios. Among other factors, we also talk about shareholding. Street credentials, that is how the stock has done, street coverage, as well as valuations finally. And to take us through some of these aspects, I also have with me my colleague Puneet Javeri, who's going to actually take us through a bunch of these ratings too. So Puneet, thanks for joining in. Welcome. Let's start with you telling us about how the revenue as well as the bottom line has grown over the past few years.
Well, definitely, the income statement is very impressive for the company. They maintained really strong revenue growth in this particular time frame, as well as, the profit streams has also flown through over the last 3 years. So when you look at the FY24 revenue for the company, it was about around 1,419 odd crores, with margins maintaining at about 8.2%. And that's very strong for an EMS company, generally, in line with industry standards as well. What's also important is that the company had a net profit of about 35 odd crores in FY24. And when you see the 3-year CAGR performance also that's available on your screen now, we see that revenue has grown consistently at 24% CAGR over the last 3 years, while EBITDA and profitability has come through very strongly as well. So the operating leverage benefit for an EMS player can be seen in this company as well. While FY23 to 24, the growth was almost flattish because of capacity constraints that the company had. It is expected to recover very strongly over the next 3 years. And as we go forward with this particular KYC episode, you will be seeing the company's initiatives going forward as well. But that's something on the income statement as well, Agam. What about the balance sheet and the cash flow aspect as well?
All right, so the balance sheet certainly looks good as well. At the moment, what we're seeing is, firstly, the overall net debt to equity ratios is, well, not very high. So we have about a 0.3. That's where the ratio is, and in healthy cash reserves. The shareholders' equity stands around 96 crores, with gross debt stands around 331 odd crores. And of this, cash and bank is at about 107 crores. But if you consider how things have panned out with respect to your overall setting, where naturally the company is in a growth phase, which means that it will require a lot of working capital, and hence its gross debt is relatively on the higher end, which is why we're going to give the balance sheet a thumbs up as well. Coming down to cash flows, again, positive cash flows from operations for the year gone by, and what we're seeing is an increase there. Net cash flow is also looking at an inflow, at least for the year gone by. The question really is that how do these things come through as we move into FY25 too? But for now, considering the fact that it's been a fairly stable run for the company, we're going to give this one a thumbs up as well. Let's talk about return ratios then, Puneet.
This is the slightly disappointing fact about the company. Like, we did look at the financials, but both the return of equity as well as the return of capital employed is, we are giving it a thumbs down, because the return ratio of 6 to 9% is something that's for an EMS company is not very strong.
Yeah.
And that's been one of the key aspects, because in FY24 specifically, as we mentioned, the company has been investing a lot in building capacities, and the new factory which has come up in Andhra Pradesh as well. And that's one of the key negatives, according to me, Agam, because this is, of course, the shareholder return as well. So that's not been good in terms of dividends, and because it's a high growth company. But both on ROCE as well as ROE in this year itself, it's been a very downward trajectory, and that's been something that's consistent over the last couple of years as well.
Right.
So slightly giving this, of course, a thumbs down in this particular aspect because of lower return ratios. But it's we'll talk to the management also on this aspect, on the improvement of both these factors.
So significant scope for improvement when it comes to ROEs and ROCEs, but let's move on. We've addressed the key financial statements and a handful of important return ratios too. But let's move on and talk about a couple of aspects beyond just financial statements. And I'll talk to you about shareholding. Now, promoter holding is not majority, less than 50%, 48% to be precise. We do have some amount of FIIs coming through and holding as much as 2%. And it's not a bad holding, considering given the size of the company at this point in time. Domestic institutions also hold a little less than 11%, so that certainly is good as well. But the outstanding, nearly 39-40% out there in public shareholding, that could potentially be just a tad bit of concern. But just for the fact that the promoter holding is less than majority, some of the aspects will not necessarily add up in terms of a thumbs up. Moving on, I want to very quickly talk about street credentials as well. Now, as far as the kind of returns that the company has given shareholders, that has been fairly satisfactory. In fact, 153% return is what we've seen since the stock was listed back in February of 2024. So it's on a very, very interesting pedestal at the moment. And while we've seen a substantial correction in your mid-cap and your small-cap indices, it does seem like EPack Durable has beaten both these key benchmark indices and given you a return. I'm not going to talk about dividends. That has been negligible, but it's a growth company, so I'm not going to use that, put that factor against EPack Durable. Naturally, it will use a lot of its profitability and put it back into its business, which is fair enough. But finally, coming down to street coverage, Puneet, what do you have for us?
Well, definitely the 150%, as you mentioned, has propelled analysts to cover this particular stock, and it's done very well for its investors over the last year or so. Currently, it has 3 buy ratings as well as 1 hold rating from analysts. With something like JM Financial has the highest target price of about 610 rupees. What's also interesting that just over the last month or so, DAM Capital as well as ICICI Securities has initiated coverage. Both have a buy rating on the stock with target prices somewhere around 500 to 600 rupees. And both of these reports have highlighted, along with what JM Financial has put out, that the AC manufacturing space is expected to go forward from here itself, because the current penetration is just about 8% in the country, which is among the lowest across all consumer durables of TVs, refrigerators, and washing machine. And that's what's propelled these ratings in favor of something like an EPack Durable, because over the last 20 years, the kind of investments they've made into setting up a new manufacturing facility, and now they have 3 of them. It is on a pedestal to grow forward with the increasing penetration of room air conditioners specifically, along with the diversification that's come in the small and domestic appliances. That's going to augur well in the off-season period of ACs, which is essentially in Q3, somewhere around the October to December period. And we see some pre-buying of AC somewhere in March, but January and February also augur well for domestic appliances. So overall, it's also a big thumbs up on that aspect that, the street has finally taken notice of the company's efforts over the last 2 decades and now are favoring in terms of, the company's performance as a whole as well.
Interesting. So this is as far as the street view is concerned. Puneet, let's talk about, valuations then, and how do they stack up as against the peers?
Now, effectively, if you see EPack Durable independently, it's of course trading at a high valuation of 58 times price to earnings. And this is also forward earnings of FY26. So a lot of positives baked in currently. But if you see its comparables of Amber Enterprises and PG Electroplast, the discussion widens and it's not as simple because the market and the street is favoring almost all room air conditioner players. And the AC space has seen higher valuations as well. So in that aspect, while EPack might be trading very close to someone like an Amber Enterprises, PG Electroplast is valued higher than the company, much higher at 72 times price to earnings. And that's also led by the company's efforts of a fundraise that we've seen for PG Electroplast. But overall, these valuations, while expensive, they don't currently bake in expectations of FY27. That's expected to be the breakthrough year for something like an EPack Durable, when they'll have utilization from its current plant almost touching the 70 to 80% mark. And that's when the revenue through and the EBITDA throughput will come through as well. So overall, the valuations, while expensive, with a strong growth projected over the next 2 to 3 years, might be favorable to look at this company again with a lens through with comparing it with the peers, as well as the strong growth projections independently for this company as well.
Okay, so that's your view on valuations, and let's put all of these factors together and stitch it up to see how the company is in fact done on the ratings that we are assessing it on. So when it comes to the income statement, the balance sheet, it's a thumbs up along with cash flow. So as far as this income statement, or rather all its financial statements are concerned, it looks pretty good. It looks on a pretty strong footing, except for the fact that perhaps return ratios have a scope to improve. But in terms of other factors, while shareholding is not the best or it's not an ideal one, we do have fairly good street credentials, street coverage, as well as in terms of valuation, though on an absolute basis, it looks like a higher number when compared to some of the peers. It is it's coming at a discount as compared to the peers. So, which is why that if you take all these factors together and put them together, well, the rating that we're getting is 6 out of 8. That's a 75% hit rate, or well, a first class with distinction. So overall, on a pretty stable footing for EPack, even with the kind of size at which it is currently operating, and there's plenty more to come from what I understand. So let's put the spotlight then on the company's strengths, weaknesses, opportunities and threats. And I'll talk about strengths first. So it is an integrated air conditioner player with about 24% share in the own design, and it signed another pact with Hisense to manufacture ACs. It's going to be a very interesting area because we're looking at a lot of traction in the entire sector. In terms of weaknesses, it does have strong competition from the entire EMS space, especially in AC manufacturing. And it has only become a little bit more competitive over the last few years. And working capital needs set to increase. So that's something that could potentially lead to at least an increase in near-term debt. Again, it's going to be a wait and watch. We're not suggesting that that is the only way. The company could potentially also raise capital from other avenues. But that's as far as strengths and weaknesses are concerned. Puneet, what about opportunities and threats?
Well, in the EMS space, the opportunities are plenty. And currently, we are looking at an increased focus by the management in terms of, the small and domestic appliance business as well, because that's taken off very materially in this particular year. And with a new facility coming in Andhra Pradesh, that's going to have more focus on these appliances. So we've already seen, the company's focus on induction cooktops, mixer grinder, among others. They're also looking to enter the washing machine space. They've already established the manufacturing facilities. Apart from that, they're also looking to introduce new products such as air fryers. So it's going to work very well for the company in terms of that opportunity. While there have been some chatter on the other aspect of a PLI scheme coming in specifically for the electronic component scheme. And how does that augur well for the company? Because it is currently manufacturing the ACs, but not the components. It has, manufacturing the components in a big way. But of course, that is, CapEx incentives. If the government is expected to come out with a 25,000 crores incentive scheme for the electronics to be manufactured in India, EPack, among others, will be one of the biggest beneficiaries of this, and this will impact the EBITDA margins very positively because we see that it's a 4 to 10% EBITDA margin range. So every potential gain in terms of EBITDA will be a big opportunity as well. While we look at the threats, of course, the valuation is leaving not too much room for any kind of error going forward. With the growth potential over the next 3 years very strong, the company will have to come out and deliver it on time on whatever they've mentioned. And also the peers have also been increasing capacity in this particular time frame. That's another key aspect to watch out for because, as you mentioned, the penetration is very low at 8%. But we see other players as well increasing capacity. While also, we're seeing the players also, the brands that operate, such as Havels, among others, have also put up their own manufacturing facilities as well. And we'll quiz that on the management as well, because there are 60 AC brands in the country. 26 of them have their own manufacturing facilities as well. So that is another aspect of how the EMS players will evolve into this because they don't have their own brands. But specifically, there are a lot of strengths, weaknesses, opportunities, as well as threats in this aspect.
Okay, well, on that note, before we get the management in, Puneet, I want to very quickly touch upon any details that we potentially have on the outlook for the company.
Well, the outlook is very strong. Over the next 3 years is expected to report very strong growth led by higher utilization. It's interesting that the company is also tied up with Hisense, which operates brands such as Toshiba in India. And that's going to be one of the biggest opportunities as well because they're going to set up an integrated plant for the company as well, own manufacturing line in terms of ACs. And that's expected to boost the company in terms of other growth aspects as well, Agam. So a couple of factors to watch out for. Yeah. And I think, the management will be the best person to answer all these questions.
Absolutely. So on that note, let's get in the management. We have Ajay D.D. Singhania. He's the MD and CEO at EPack Durables. Ajay, good morning and thanks for taking the time out. We've gone through a lot of the aspects of your financials and they certainly look very, very strong as of now at this point in time. Our first question for you would be what FY26 looks like in terms of operations. What kind of growth are we looking at in terms of expansion? Are we looking at further, increase in terms of your production as well? What can you tell us?
Yeah, so good morning and thanks for letting me in. So see, definitely, first of all, on a very robust growth in FY25, the industry is going through like 40% plus growth for AC, our core product. So definitely FY26 also the foundation laid currently is that the industry again is looking at a positive growth. Everybody's been talking about 20% growth at least for AC again in 26. So and we are all charged up and looking at the order books and the upcoming season for especially AC. Things are aligned well in terms of capacity utilization, and we are looking forward to again very good growth in FY26.
Ajay, before I hand it over to Puneet, my next question is that are there new areas that you are looking to enter into in FY26?
See, particularly FY25, if I talk about, we already started our new division called Large Home Appliances, wherein we launched air coolers, and then subsequently we have already developed washing machines. So washing machine is one area where we want to continue our focus throughout the next year, at least this calendar year. So we'll be ramping up our capacities for washing machines substantially. So starting off with the fully automatic, now we are looking to also get into semi-automatic and so on. The core focus will remain to ramp up our the large home appliances division, especially washing machine throughout FY26, and also a lot of smaller appliances, the newer age appliances, especially wherein we see QCO coming in, so the imports getting banned. So like you talked about air fryer. Similarly, there are other appliances also where we see a lot of opportunities to enter into manufacturing in India. So our journey both for small appliances as well as larger appliances will continue to grow.
Mrs. Dingana, good morning, sir, and thank you so much for joining today. It's Puneet this side. I just wanted to ask a question on the component side because that's been one of the most interesting opportunities going forward. Now, I did see in your presentation that you already cater to a lot of components in India. I just wanted to understand what is the current, components and bill of materials that you cater to at the moment, and where do you expect it to go by FY26? Because that will, of course, positively impact the margin. So just wanted to quantify, if you could tell us, if you're around 20 to 25% in terms of bill of materials today, and where do you expect to be by FY26 end?
Okay. For components, especially there are two areas. One is our own captive consumption. So as far as our captive consumption of components is concerned, especially AC, we almost do 65 to 70% of components in-house. So that's for our own use. So theoretically, I say that except compressor, we almost manufacture all the components in-house. For motors, we have a JV company, so it's a 50-50 JV where we also make the BLDC motors. So Including that, if you see our own bill of material, 65 to 70% components get manufactured in-house. Now, at the same time, we also have opportunity to utilize these manufacturing capabilities to supply components to other manufacturers. So this is one area in terms of component business, we see growth coming up pretty fast in the going forward. So we already started supplying one component called cross-flow fan in big way to almost all the manufacturers for air conditions. Similarly, we are now utilizing our PCB controller lines to make the electronic controllers for a lot of customers. And this is all on top of our own captive consumption. So, now copper tubings and system tubing. So we see a lot of growth in the component business. FY24, our component business contributed marginally like 2 to 3% of our total revenue. And we see significant growth in our component business going forward.
Just want to take that point, Mr. Singhania, because you mentioned 2 to 3%. So about 80 to 100 crores was the revenue for your components business. Where do you expect it to be for FY25? And I know you're in silent period for Q3. So any kind of long-term outlook that you have for FY26, where do you expect it to be? And would it be safe to say that margins in components specifically will be around 20-25% because that's the higher margin business?
Definitely, yes. So when I agree that component is a high margin business, and our forecast or the way we see our component business grow in the next 3 to 4 years is definitely to contribute anywhere between 8 to 10%. So we're substantially increasing our component business, and we see component business ramping up to at least 8 to 10% of our revenue in the next 2 to 3 years.
Ajay, my question then is, what would the overall company revenue mix look like towards the end of FY26?
So specifically not 26, let me take a little further.
Sure. Yes, go ahead. Yes.
27, 28, if I see somewhere around 27, 28, our revenue mix should ideally be around 60-65% from the AC business, which currently is 80% plus. So 60-65% from AC, almost 8 to 10% from the component business. And the large home appliances, which we recently started, should also come up to 10 to 15%. So that's where we see the substantial growth coming from the large home appliances, especially coolers and washing machines. And then the balance from the small domestic appliances. So small domestic appliances definitely continues to grow, but because the ticket size is small, the overall contribution on the growth remains slightly smaller.
Mr. Singhania, I also want to just take forward the point of your recent, partnerships with Hisense as being one of the key aspects. Now, you did mention that FY26 is you are going to put up an integrated line of about 1 million ACs for them. What is the other scope apart from ACs and washing machines that you're looking for them, and what do you see the revenue contribution as? Because there has been some brokerage reports that have been seeing that roughly about 8,000 crores of revenue is the opportunity over the long term for you. And now I know while you can't confirm the number to us, any kind of outlook in the near term between 26 and 27, specifically from this new partnership of Hisense?
So see, for our Hisense partnership, we are looking to ramp up capacities starting with 0.5 million. So 0.5 million in the calendar year 20. So around July, August is when we are looking to start this new facility for Hisense, setting up a capacity of 0.5 million, which we will ramp up to 1 million, then 1.5 million subsequently in next 3 years. On the top of it, washing machine is something which we will be supplying to Hisense as our own complete product. So that would remain an ODM product from our side. AC would be there in the dedicated new integrated facility. And going forward, Hisense definitely has plans to enter into other appliances also in India, like refrigerators and then front load washing machines and the entire range of appliances what they manufacture in China and globally. So all these products will definitely come up in the long term. So, but to begin with, yes, AC and washing machine is the product we are going to start immediately. And from within the next 5 to 6 years, we are looking at a revenue of almost $1 billion from this entire transaction with Hisense.
Okay. All right, Ajay, we'll leave it at that. Thank you so much for joining us and taking us through your views and, of course, giving us so much more insight with respect to what the prospects of the company are and what they hold going forward. Thank you so much for joining us.
Thank you so much.
Well, there you have it. Well, that's the end of this edition of KYC. Lots more lined up. Stay tuned to NDTV Profit.